Hey, everybody, welcome back to another episode of the Work Hard, Invest Harder podcast. I'm your host, Justin Dixon, and today we've got Brandon Jenkins on the pod. He is the founder of Birch Prosper, a real estate investing company. He's also the host of the Capital Stack podcast. So we dig into his evolution going from an oil and gas chemical engineer living in Houston to dipping his toe into the real estate world with single family. We actually dig into his process of how he did a lot of research, built a lot of education and a lot of relationships before he even did his first deal, which helped him scale his single family up to 12 units before then shifting into the multifamily syndication space. So we talk about a lot of things, what's going on in the market today with our high interest rate environment, where he's looking for deals, where he likes deals, and then we dig into, we talk about the book, Who Not How, a little bit, that we're both super passionate about. So anyway, let's get Brandon onto the pod.
Do you love your job, but want other investment options than your company's 401k and trying to pick stocks? If so, you've come to the right place. In this podcast, you will get actionable information for your passive real estate investment journey. Welcome back to another episode of Work Hard, Invest Harder podcast. Here's your host, Justin Dixon.
All right, Brandon, man. Hey, welcome to the podcast. Happy to have you on.
All right, man. Justin, thanks. It's a pleasure to be here. I really appreciate it.
Appreciate you coming on. So I guess let's kind of start off, give everybody kind of a quick overview of you, what you're doing in real estate, and then we'll kind of, unpack some stuff.
Would love to. So I'm gonna start kind of with what motivated me and kind of what drove me to do this. So I started off professionally as a petroleum engineer. So I worked in oil and gas for 10 years down in Houston. I'm in the DC area now. But
Okay.
my wife and I lived in Houston at the time, and really good business, And so, anyone who kind of knows some of my background, they know that I really enjoyed what I did. It was hard work, but it was really good work, good pay, great pay. The oil and gas industry, however, though, when it's good, it's really good, and then when it takes a dip, they tend to show people the door.
Mhm.
I had kind of a unique experience in the grand scheme of things because early on, I got to work on really large capital projects, large teams. I learned a lot about project management, business development, things that, unbeknownst to me at the time, really kind of helped me farther along in my, once I shifted to investing. But I was an engineer for some time. I worked through 3 different downturns, and the second downturn, I always had an interest in building wealth, but I didn't really know which vehicle I would use. The second downturn, however, was the one of the worst in history, where it went from like 126 a barrel down to $18 a barrel. Talking about the price of oil. And so at that time I said, well, I really need to find something to offset some of this volatility.
Yeah.
Started investing in real estate, started off on the single family side. So I did the BRRRR strategy, and I had 12 properties and wanted to scale. So I started to look for apartment deals, and it kind of small, like 20 unit sizes at the time, and they fell through. And in hindsight, I probably could have bumped up my offer price a little bit and got those deals, but I'm glad I didn't. But so one of my coworkers at the time, he also invested in real estate, and so he said that, hey, listen, I've heard about these multifamily syndication meetups, and we went to those, and it just went from there. So fast forward to now, I've invested in a handful of deals as a limited partner. I've been in about 11 deals as a limited partner. I'm a GP in 3 deals. And so that's what I do right now. I'm a multifamily syndicator. So I'm a sponsor on deals. I look for them. I get properties sent over by brokers. I run the numbers, and then I determine whether or not it's a good opportunity to bring to my investors.
Got it. Well, there's a lot there to unpack. So let's kind of start out with, you were living in Houston in oil and gas. I've known a lot of people. I live in Austin, so Texas. I meet a lot of people that lived in Houston or live in Houston, and obviously Houston is very tied to the O&G space. I guess at what point, you mentioned kind of the downturns kind of started to spur you on to think about, okay, this is a boom and bust industry, right? It's great when it's great, it's bad when it's bad. From an employee perspective, right? You kind of ebb and flow with the price of a barrel of oil.
Mhm.
How did you start to think about the shift of like, okay, I need to start investing my money for, not just the 401k and the stocks, but like other things that are going to generate wealth and income? Like, how did that evolution and that mindset kind of start to shift?
That's a good question. So I actually, it was sort of born out of curiosity for really with the credit crisis. So
Mm.
I was in grad school when the credit crisis hit, and at the time I was like, man, I'm not really understanding kind of what all the what the big deal is, because I didn't feel it, but I was a student, right? So
Yeah.
so so I really got curious about different asset classes and how to build a portfolio that really checks a lot of boxes that meant something to me. Like I want something that in the end is kind of a non-correlated asset. I wanted something that was tangible,
Mm.
something that where you could actually go and drive real change that really was sort of on the brick and mortar side, but where you had this asymmetrical return profile to it. And so I read a bunch of books. I listened to a bunch of podcasts, kind of in the early days of podcasts.
Yeah.
But what made the biggest impact, honestly, was one of my college buddies. He lived in Houston as well at the time, and he flipped properties. And
Really?
so I drove out one time and kind of said, I want to take a look at this operation you got running. So I went out there and looked at what he had going on. And as we were kind of driving the area, he said, "Yep, I own that one, I own this one, I own that one." And I said, "You know what? I want in." Um,
Right.
but I realized that model didn't really suit what I was looking for. So I wanted to get into real estate, but I wanted the cash flow. I wanted some
Yeah.
semblance of predictability, and so that was kind of what really was the catalyst for me getting into the real estate asset class.
Yeah, it's one of those things where flipping is great because it can drive a lot of cash, like cash flow, but it's very active and you always have to be doing it, right? It's not a
Yeah.
set it, forget it. It's a very active income stream versus, apartment investing, especially as a limited partner, your biggest hurdle or biggest active part is just wiring funds, in some
Hmm.
respects. So let's shift a little bit to kind of the evolution and okay, you did a bunch of research and being an engineer, you have a very analytical, process driven brain, I'm assuming, just judging by the folks that I've talked to in that space. At
Hmm.
what point did you say, okay, enough's enough from an education standpoint? I need to start, putting some meat behind this and actually, betting on myself that I know enough about what I'm reading and can actually execute on your first deal. And let's talk about that first one and the pluses and minuses and things maybe you would have done differently.
Yeah, excellent question. So, it actually kind of stemmed from my background working in the field. So, ultimately, what let me know that it was time to execute was when I had a fully baked plan or
Mm.
procedure, I'll call it, because the main reason why I consumed the podcast, the books, everything else was because I wanted to formulate a process. I wanted to say, okay, well, real estate has been around for forever. And so there is, in a sense, some finite start and end in terms of when you are interested in potentially buying a property to when you acquire the property to when you put a tenant in. And so I
Yep.
wanted to come up with a roadmap of sorts and to do that. And once I felt that I had adequately sort of characterized that entire process, then I was like, okay, well, you know what, I'm going to take action. But what's interesting is I was still pretty scared. I mean,
Yeah.
so the first property I bought was this little single family property that was like an hour outside of Houston. And it was like, I mean, it was maybe 70K, a little bit under 70K, but I
Okay.
knew that I could rent it for about $900 a month or something like that. Um, but I'll tell you one thing that made me feel more confident in doing it actually was that I made connections with the people who were going to help me get it done before
Mm.
I executed. And specifically in this case, I sat down with a bunch of credit unions and lenders in the market, and I sort of presented kind of here's what I'm looking to do. And I actually established an understanding up front with one of them that said, hey, listen, I'll buy the property cash if I bring it to you and I show you my numbers and my plan. Then would you support a cash out refi of 80% loan to value? And sure enough, they honored that agreement for not only the first deal but on subsequent deals. And so that also gave me that push. That's like, okay, you know what, I've checked enough boxes. I need to go ahead and take action, and it went from there.
Interesting. I wanna kind of unpack that a little because that's an interesting layer of effort and layer of work that you went into kind of building those relationships up front. But before we dig into that, let's take a quick sponsor break and we'll be right back.
Whether you're trying to hire a full-time employee or a contractor to fill a gap, Hire Tomorrow can help. Hire Tomorrow is a boutique recruitment firm that has successfully filled sales and marketing, human resources, and technology positions with companies ranging from startups to Fortune 500. If you're struggling to find the right talent, check out hiretomorrow.com or reach out to recruiting@hiretomorrow.com to see how they can help.
All right, we are back on the Work Hard, Invest Harder podcast with Brandon Jenkins. So before we took a quick break, you mentioned kind of before you even landed your first deal, you spent the time to build a process, right? And try to put a little bit of your engineering background and education to work in the real estate world. You met with some credit unions to explain to them what your plan was to buy these properties, at least initially in cash, bring it to them and do the BRRRR method, right? You buy it, you renovate it, you refinance it, you rent it out, repeat. I can't remember if that's all the R's, but and so that's very interesting. So you kind of gave them a model or a plan, and then you said, okay, I'm going to go buy this property, and you found one, bought it. Well, I'm assuming with cash, and then essentially executed that plan. Like maybe talk through that first one and how that actually worked.
Yeah, I'm sure. It's, I'll tell you that one thing that was interesting to me was when I had the conversation with the credit union, they sat me down and said, Brandon, you're the only person that has ever come and shown me something like this. And to be honest, going into it, my assumption was that was the norm. I mean, because I'm basically asking them for, to be a partner in the deal. But so basically what I did was to do a market survey because I wanted to feel comfortable knowing which submarket I was going to buy in. And so at that time I used like citydata.com. So I just used kind of a, and then Spot Crime and a few other websites where I wanted to make sure I had some information to back up my decision. And so when I went to the credit union, I said, hey, listen, here's my business plan. And for a property that costs on average this amount of dollars and that can rent out this much, I'm looking at these specific zip codes. So that's the reason why I wanted to build relationships with local banks, because they could have an appreciation for the actual locations. And so once they saw that, okay, these are the neighborhoods he's looking at, he actually did some work around this specific submarket. So that was kind of the approach that I took to it. And I showed them this, this little packet. And I had a few of them that were lined up and ready to go and ended up deciding on one of them. But that really helped me sort of push myself over that line, because I was pretty nervous, but the more upfront work I did, it really, really gave me the confidence to say, okay, well, I'm going to take this and run with it. And of course, once I bought the first one, it was off to the races. I mean, it's only like about 2 years maybe 2.5 years that I bought those 12 single family properties. Yeah. So, yeah.
And that's interesting because I feel like I when I first started out, I thought about the BRRRR method and looked into it and obviously read books and listened to podcasts about it. And part of the nervousness was, let's say you get a property and maybe it doesn't rent for what you need or whatever, and you don't have the certainty, if you will, that it's going to definitely refi. And if you wait to get the relationships with the banks after you get a property, especially your first one, because you don't have like experience or track record, it can be a nerve-wracking thing where maybe they say, now we can only do 75% loan to value, and you were expecting 80 to make your deal actually, fully work. So I think that's really smart that you spent the time and effort up front to say, yep, if I bring you this exact type of deal, right, and it's gonna, the loan to value is X, and you're gonna, give me that back, and I can then execute on my BRRRR method, pull all your cash back out, and just rinse and repeat that theoretically as many times as you possibly can. At least that gives you more certainty going into that deal to know that, okay, I have a banking relationship or multiple that I can execute on that plan. That's really fascinating and brilliant, frankly. I'm sure other people are doing it. That's the first time I really talked to somebody that spent the time up front. So that's super interesting.
Thanks. I'm gonna throw one quick thing into that. I would say for anyone who's listening to that and who's interested in doing that, one of the things that helped me was I focused on portfolio lenders, and that allowed me to then go beyond that 10. I'm not even sure if that limit is still there, but it used to be like a limit of 10 mortgages that you could have. But if you go with a portfolio lender, you could break through that. So just a kind of little nugget to throw out.
What's the difference between a normal lender or a portfolio lender?
So I know that portfolio lenders, they tend to keep theirs in house, and so they don't always shop it on the secondary market. And so they aren't limited by, like, honestly, I forgot what that rule is, but usually you're capped at like 10 mortgages or something like that. So yeah, that's right. And so you're if you go with a portfolio lender, they keep it all in the house, and so they feel more confident than having a client that has more than that 10.
Yeah. I always found that an interesting rule to have 10. It's like, what's the difference? I can go buy a 20-unit apartment complex. And obviously it's
exactly.
Stuff, but yeah.
It's arbitrary.
So the normal kind of evolution that people go through in the real estate world is you start out in single family and you check that box, right? You did 12 and then you're like, okay, well, this is great, but it's pretty active, especially because you're doing a BRRRR method, because you're buying it, you got to renovate it, you got to rent it, and then you got to, rinse and repeat that whole process. So then it sounds like you scaled to 20 units or to kind of like smaller multi. So talk about that evolution, and at what point did you think, okay, BRRRR isn't enough, single family isn't enough. I need to go a little bit bigger, because it is like sometimes a mindset jump, right? To be like, I'm not ready for the 20 unit yet, but let me cut my teeth on the single family, maybe get a duplex or something, and then say, okay, now I can go to the 10, 20, 30 units. So let's talk about that evolution and what caused you to jump up to the next level.
Well, yes, sure. The first thing I'll clarify that after I bought the last single family property, I actually didn't buy some of the ones that were around 20 units and around that range. I put in offers on them, but I actually didn't get any offers accepted. And that was when I shifted to investing as a limited partner syndication deals. I did want to talk about the mindset piece, because that was a big issue for me. And I think that for a lot of people who start off as single family investors, it's a challenge, because what you go from wearing all the hats and being the captain to then saying, okay, I'm going to be a part of a team. And obviously that's a good thing, but the difficulty and the friction that tends to be there in making that adjustment is the trust factor, right? Because you have to say, okay, you know what? I trust that the people who I'm partnering with, they're going to be able to handle their piece the way that I would, right? So it took me some time to really sort of vet out the people that ultimately that I'll be working alongside, like that I'm a co-GP with now. But I knew even then that I knew I wanted to be a GP on deals, but I knew that I needed to learn just a little bit more, because the adjustment from single family to multifamily is not always a seamless one. There are a lot of people who make the attempt and don't do well. So I knew that I wanted to go with groups that were experienced. And so what I did was to actively then seek out mentorship groups. And I partnered with people who I knew their track record was really strong. So I started to invest in their deals, and I started to get more information, sort of quote unquote insider information as a limited partner, to where I felt confident in my ability to then be a GP where I'm now. So it was a very gradual sort of thing for me. It doesn't necessarily have to be that for everyone else, but for me, again, I felt a lot more comfortable sort of making that sort of shift in that gradual progression.
Yeah, and I think it makes sense to start out and my first multifamily investment, syndication investment, was as a limited partner for a couple of reasons. One, I started underwriting these bigger deals, and it's way different to underwrite a 150 unit apartment complex than, a single family house, right? And so there's a lot more education that goes into it. And I think, I found one, and I was like, this is back in, 2020. And I was like, well, what happens if I actually find one that's really good? I don't have any experience or track record or network of people or, tens of millions of dollars to take this thing down. So me finding one is not going to help. I need to surround myself with these, like-minded people. And it sounds like you mentioned earlier that you started going to meetups and syndication meetups. And I think those are super important. Whether you want to be active or passive, that's where you're going to meet people that are actually doing deals. And to your point, you need to build some type of trust and familiarity with these groups to find their track record and how they actually performed in good times and in bad, right? But going back to your kind of evolution and the first time you kind of invest was passively, it does give you, even though you are a limited investor and you don't see, exactly how everything, kind of was made and how the underwriting exactly was kind of the evolution of that. you at least can see the inner workings of how the GPs communicate, right? What they communicate, how they present the deal, what they sell, why they pick this market, why they pick this deal. And it kind of starts to validate some of the things that you're learning, especially if you want to become, a GP on some of these bigger deals. Is that kind of what you thought when you kind of went through that limited partner process?
Absolutely. I like to call it kind of the earn while you learn.
Yeah. I've heard that before. That's great. Yeah, I like that.
Yeah, because, and I share that with people now. So I have a meetup. Like I mentioned, I'm here in the DC area. I have a meetup here. And one of the things that I'll ask the attendees is like, hey, who wants to be a GP? And usually everyone's hand goes up and say, that's outstanding. So, okay, how many of you have invested as an LP? And then very few hands go up, maybe one. And I like to share with them that there's a couple of things. One is, I believe that you will find it very difficult to jump straight to being a GP in these kinds of deals. You mentioned it as well, right? It's that the analysis is very different. So even if you have experience on the single family side, you no longer can just stop at cash flow. You now have to take it a step further to say, well, what's the return to my investors? Because as a single family investor, you're okay with it. Does a cash flow $100 a month, couple $100 or $300, $400 a month? All right, cool. Let's buy it. Right. But there's some more steps that are needed. And even above before we even get to cash flow, there are a ton of things that you have to understand from a due diligence perspective in terms of the different line items that are very different from single family. And so I absolutely think that if anyone that is thinking about going to the GP side, you absolutely want to step in as an LP first. Understand, like you hit it on the head, right? How do the sponsors communicate? How frequently do they communicate? What are the things that they're highlighting as they do CapEx and as they take over the property? There are phases to this type of work where you just don't have any exposure to that unless you are in a deal. And so that's that for me that's exactly how I experienced it. It gave me the opportunity to say, oh, okay, this is very different. And I'm seeing it first secondhand, how the game is played.
Yeah. If you get to know the GPs, like one thing that I did when we first, invested as a passive investor, I asked the guy, I was like, hey, well, first of all, we used retirement money, right? I shifted some old retirement money from a 401k into a self-directed, which I had no idea that actually existed before, digging into the real estate world. You get to learn about all these very interesting things that are fully legal and accessible to everybody out there, that you just don't get access to if you're just, a normal steady Eddie. If you don't have the, this type of education around, finance and stuff, it's super fascinating. So that's one thing.
Yeah.
So I talked to the GP because I got to know him a little bit, and I said, hey man, like, I know I'm an LP on this, but I'd love to just kind of peek over your shoulder at, actually what your underwriting looked like. And because we were in the same group, so I knew his analyzer really well. And I had been doing a lot of underwriting myself. And so, you can learn more as an LP if you find the right general partners that are going to give you, a little bit of a peek behind the curtains, so that you can ask questions. And especially if you want to become a GP and be the one that's leading deals, it's good to find those general partners that you can kind of learn from. I don't know if you took that path, if you kind of got a little peek behind the curtain, so to speak, as an LP.
I did. Absolutely. I did. I kind of made my intentions clear. And I'll tell you something, this is yet another sort of piece that I normally will share with people. Experienced GPs are not likely to pull someone onto their team as a co-GP if they've not invested in a deal.
Yeah.
It just because there is a difference between it's not even just talking about kind of the things like commitment, things like understanding kind of the ins and outs of a deal, understanding what questions to ask, understanding kind of what the process is. Because if you're going to be a GP on a deal, then, when you take over that asset, first of all, before you even buy, you have to be super present and focused and understand what the process is. But once you close, it's time to hit the ground running. So you're not exactly waiting around to field, a bunch of questions at that point. And so I like to share that with people. It's like, listen, if you want to be a GP, I advise investing as an LP. But while you're in as a passive investor, just let them know, hey, listen, like you did, I kind of want to understand a little more about your underwriting, if it's okay. I want to understand kind of what the due diligence process, how you did your lease audits, how you did your unit walks, all these things that are vital to the success of a deal. And I think that, most GPs are going to be amenable to that. They're going to say, sure, let's talk. So,
yeah. And I think that one thing you mentioned around due diligence is really interesting because, some LPs I've seen they'll go to due diligence, like physical due diligence, go to the property that they're thinking about investing in, or maybe they've already invested in because they know, like, and trust the GP. But that's not always accessible to everybody. A lot of these things are out of state. But if you live closer and or you feel like going on a tour, within reason, the GPs will be like, yeah, sure. Obviously that person would be a fly on the wall, so to speak, where you're not going to be asking a bunch of questions in the moment. You got to kind of be respectful because those due diligence process are well-oiled machines typically, and they don't need, people just buzzing around asking questions. What's this? What's that? How does that work? Kind of thing. So, but that's definitely open for the option. It should be open in most scenarios is to visit the property on the due diligence tour, get to see the property maybe before you actually pull the trigger and invest, so that you feel as comfortable as possible as an LP. And also it'll give you really good experience to transition over to being a GP. So you mentioned that you have a meetup. I think that's super fascinating, something I've thought about doing. There's meetups here in Austin, but they're not always right next to where I live, which is where I'd like it to be, frankly. But I'm curious about how you started that, how long it's been going, and what. Maybe let's start there, and then I got a couple more.
Sure. So it's been over a year now. And I tell you, I've come to really, really, really enjoy it. I mean, because I used to go to meetups, myself when I lived in Houston, and actually when my wife and when we moved back here to DC, I started to look for meetups in the area, and I was like, there really aren't any that fit what I'm looking for. Yeah. And so, and it took a lot out of me, to be honest, but I said, you know what? I'm going to start one. And so I decided to go ahead and launch one. I went on meetup.com. I already had an account, but I launched a group on there, and it's a community at this point. So one thing that helped me was I knew I wanted to have some structure to it, because initially what I would do is I would just kind of pull some slides together from a group of topics, and it was a little bit random, but the slide decks were still valuable. But where we are now is we have 8 modules, and so we've really structured it to where each of the subtopics in the 8 modules, they fit within one of 4 groups. One is the fit. So is it a fit for you as an investor? The other one is the sponsor, then the deal, and then I think the structure of the deal. And so we kind of have one thing that we pick from each of those groups, and usually pick about three subtopics, and then that becomes a module. And I'll put a slide deck together there. We also have a virtual meetup that we do once a month now as well. So it's really starting to grow, and just to be able to see people network and build together and connect offline. So it's turning into something that is just fascinating. And so I'm glad I sort of got the nerve to say, let me go ahead and start one. So, yeah.
That's awesome. Have you how big is it? Like, and also, have you seen it translate into people investing in deals? Or maybe it's not your motivation, but obviously if you're a GP and you're finding deals or raising money, the goal would be to obviously educate people that may not have the ability to learn about this stuff, and maybe this is their way to kind of break that barrier, but also to present yourself as a thought leader, and then potentially have those people that are maybe looking at becoming an LP or a GP, and they can then invest through you. How big is it, and what's the return on that investment, if you will? Has that trying to translated?
Yeah. So at this point on meetup.com, we're almost at 600. The in-person events tend to be about 30 or so. That's awesome. That actually show up, and so I've had a few investors from it. I think they're going forward, because to be honest, I was hesitant initially to aggressively sort of present my deals at the events. But at this point, we've had enough repeat, attendees to where I can sort of say, okay, listen, for the folks who have been here for some time, we've already built up that substantive relationship, and we'll go ahead and get some deals going, and we'll talk about it. So going forward, it'll be even better. But yeah, it's been incredible. I mean, we're continuing to grow, so we're looking to get an even larger space and get more people and things like that. But I forgot what your other question was. But that's
No,
but that's
you answered it actually, because I was asking if anybody's actually invested because of the meetup, and it sounds like you've had at least a handful of people that have gone through, and that's because obviously it takes time out of your day, and you've got to put forth effort to put on and go to and host and find spaces and all that fun stuff. So that's amazing, because I talked to a buddy of mine who actually lives in Houston, coincidentally, who started a meetup, and while he had probably, I think, 10 to 15 people-ish come to his events on a monthly basis, he felt it was more, the juice wasn't worth the squeeze, if you will. And so I was just curious to kind of get your experience. It sounds like you have a larger and / maybe a better run meetup. And I would say that to my friend's face if
he's listening.
But no, I think he was just like, hey, it was a lot of work, and he has pulled in a lot of directions, and it was like, I'm not seeing the benefit at the moment to him and his deals and all that stuff. So.
I'll tell you a couple of things that for me were very helpful. One is, I would say, as soon as possible, identify who can help you with the meetup. Things like it's even simple things like making sure people are signing in. Making sure that the word is getting spread. I mean, the reality is you have to make that decision around whether you're going to be the one, because that's how all these things are, right? They always start with someone really, really, really leading the charge, and then after there's some real serious momentum being built up, then other people will sort of fall in line. That's just how it works, and so that's how it's worked with mine as well. I will say though, one thing that came out of this is that I did not foresee, but at the end of each meetup, people will come up and say, hey, listen, well, if you have something kind of one-on-one, I'm really interested in that. And I was thinking, well, I really don't have anything. This is sort of the extent to which there will be any one-on-one. And so after each meetup, though, people will come up and say that. And I was like, well, maybe I should think about it. My wife was like, you need to do something because they're asking. And so I thought about a way to sort of help some of the people who are there move the needle and sort of skip ahead of some of the years and years and years of work that it really takes to get there. And if you think about it, an experienced GP is looking for three things on any particular deal, right? Who can secure the loan, so a KP, who can manage the asset, so you're going to have to be an experienced asset manager, and then who can bring the capital to the deal. Now, all three roles, you're still going to have an ongoing role within the syndication going on. But those are the three key things. And so I thought, well, okay, what I need to do then is pick the one that can move the needle the most, where you can still have not an extensive amount of experience, and that is to help bring the capital to the deal. Right. So that's one thing that I help people with now is I out of the request that came out of the meetup, I launched a program where I really help people understand how to attract capital and stop chasing capital, and so it just becomes a lot more easy then to execute deals. So that's kind of that's one thing that's come out of it that I completely didn't expect, but it's been a pleasant surprise.
Yeah, no, I mean, that's awesome. I mean, you kind of put you created a space for people to come and learn. And sometimes when you create that space, some people are like, I want to learn more than what you're just sharing in this hour, whatever, meetup. And I've heard that happen multiple times where people are like, hey, give me some more. And then you start a coaching business or a consulting practice or whatever it is. And so, you got to give what the people want. And it sounds like they want to learn more about becoming a GP. So I know we kind of diverted into that meetup, but I thought that was very fascinating. I want to kind of shift a little bit back to, multifamily real estate and the deals and stuff. And so you mentioned you're an LP, I think in 10 or 11 deals. And you're a GP in 3. So let's talk about the GP side. Where are they? When did you get into them? And at a high level, how are they doing? Because right now, if you read this multifamily is falling off a cliff, I don't think that's 100% accurate. But there are deals out there that are not doing the best, and there are some deals out there that are doing fine. So yeah, let's talk through those.
Sure. So the 3 deals that I'm a GP on, one of them is in the Northeast Houston area. Okay. It's actually in Humble, but it's that kind of Northeast Houston submarket. The other one is west of Lake Conroe, so it's north of Houston. And then the third is in Arkansas, so it's Northwest Arkansas. It's a really good market. It's one of those markets that has kind of flown under the radar, or at least historically it did. But now there's this increased focus and attention because there's just a ton of growth in this market. So I'll say that all the deals are doing fine. There is one where we are evaluating an exit. and there's some reasons behind that. Not that the deal itself is in trouble per se, but we're evaluating exiting that one shy of the full holding period. And the other two were just, they're really, really good deals. What I did was I started to kind of see that there was a shift, say last year or even maybe 18 months ago, to sort of this flight to quality, right? And this interest in preservation of capital. And so for me, that meant that, okay, that's a signal that either a solid sort of class B plus or a class A is really what investors are looking for. And sure enough, that was correct. And so the two deals that are the one that's Northeast Houston and the one that's Northwest Arkansas, they're both solid class A deals. And they're both really good on preservation of capital. Now they still have a value add element to them, but as cap rates start to expand and valuations are sort of reassessed, those two deals will hold their value really well because you have that sort of natural barrier to the ebbs and flows of cap rate expansion. Although it'll still take place, but just at a much slower rate, right? So it won't negatively impact the deal.
Yeah, so, the classic value add, deals, the class C's or whatever are, those are the ones that are more or less impacted by the crazy rate hikes and all that stuff for the last 18 months. So that's interesting. I've seen a lot of people kind of do that. They've shifted, maybe they're selling their class C asset and buying an A or a B plus and all of that. Typically cash flow from a return profile is lower in these higher class assets, but to your point, it's more of a, let me put my cash in something that's still going to provide some cash flow. It is an appreciation play more than at that point. You're assuming that value is going to hold and obviously increase as as the hold period goes on. So that's interesting. I like the Northwest Arkansas market for sure. Definitely was under the radar probably 3 years ago, and now it's where especially in the multifamily real estate ecosystem, that's not a secret anymore.
No, it's not.
And what was your role on those three deals? Did you find them? Were you kind of one of the co-GPs? Like, how did that all work?
Yeah, co-GP. So I brought capital to the deal and now helping with the asset management on them. Okay. So that's the role that I play in those. Usually I like to be, if possible, kind of brought in when we're doing some of the upfront analysis, but in this case, it was more verification of the analysis and putting some input in, but then bringing capital to the deal and now helping with the asset management.
Got it. And then are they all under the same kind of lead guys or are they, I'm just kind of curious if you kind of found a group of deal finders and you're just kind of part of their ongoing co-GP contingent where if they get a deal, you're part of that, like, hey, we need some help, on the asset management and bringing some money.
Two of them are. So there are two of them where that's the case. At this point, I also look for my own deals. So I'm underwriting to be a lead GP. But in those two instances, yes. I don't mind saying, I think it's important for the listeners is that, listen, when you kind of have vetted a sponsor, you've seen the track record, especially if you've been sort of an LP in a deal that's gone full cycle. And so you really understand how they work. I love kind of having some capital with a group all the time. Even if I'm a co-GP, I'll no problem. I'll be a co-GP on the deal with them because I know how they work. Yeah. Because it just to me adds that layer of certainty, confidence, protection as you continue to build wealth. Who you're building wealth alongside. So I'm fine with kind of riding as co-captain on those. But for me, like I said, I also underwriting my own deals and looking to be a lead GP as well. So.
Yeah, no, I think one thing that's good and bad about multifamily syndication is there's no credentialing needed to get into it, right? There's very little entry other than just starting, right? Literally start this, today, just starting to underwrite and figure that out. So that's good and bad, right? It's good because then a lot of people can get access to it and be involved. But then bad because there's, just a lot of people out there hunting down deals. And we all saw, what really happened in 21 and 22 is that valuations went sky high and, some of them maybe they bought too high, right? They outpriced it. And now, we're seeing some of the aftermath of that. going on in the market now, and probably will be over the next 12, 24 months. So I think it's very, very important to find a general partnership team, especially if you want to just be a limited partner. Find somebody or some buddies that you can know, like, and trust. You feel comfortable and confident that, yes, especially if you've done a deal full cycle with them, you know how they operate. There will be obviously ups and downs through any deal, but it's not easy finding people that are that you feel 100% confident to be like, yep, I'm going to put money with this person on an ongoing basis, and that's the goal, right? That's the goal, is to find people that you can do business with, and you feel comfortable when they say, hey, I've got a deal, that at some points you just like say, cool, where do I need to wire the money, as opposed to, well, let me do my due diligence and dig in and all that fun stuff. So that's awesome. I guess now that you're looking at deals, or you're continuing to look at deals, what's your I guess two things. Has your return profile changed in this new high interest rate market? And kind of question B on that is, have your investors, your LP that you bring deals to, have they also shifted their appetite for a lower cash on cash or total return profile? Because it's just hard to get deals to pencil right now that have the high cash on cash plus the 2-3x multiple on the equity in a 4 to 5 year time horizon. So let's kind of start there, because I'm just kind of curious. I've asked a couple people that over the last couple months.
Yeah, there definitely has been a shift in return profile. So if you remember, like a couple of years ago, I mean, we were seeing IRRs of 18, 19, 20+% on a regular basis. Equity multiples like 2.2 and north of that on a regular basis, and cash on cash is sitting at, I don't know, 7, 8, 9% or something like that, and maybe more.
I've seen like 12, 14,
there we go.
A few years ago, and it's like, if you can get it, great. That seems outlandish, but hey, it is.
Yeah.
We all need to realize that it is an Excel document that people can manipulate.
Yes, right.
Trust but verify, especially if it's a brand new syndicator that you're working with. But anyway, sorry to cut you off. Yeah.
No, you're fine, and you're correct. I mean, it's trust but verify. That's kind of the name of the game. It's like no one's going to show you a bad deal, or you can always kind of rework the numbers. So for me, at this point, where I am now, is like, if I can get north of 15%, north of 16% IRR, I'm good to go. Equity multiple, I still like, I'm a 1.7, 1.8, and north of that, I'm good. And then cash on cash has definitely come down. I mean, at this point, if I'm 7% and up, and I'm good to go on that deal. And I'll make a point too about this that's essential. We can't time the market. And but what we can do is, with the phase that we're in, with the period of the cycle that we're in now, wherever you are, because each market is in its own spot within the overall real estate cycle. Right. But wherever you are, find a deal that is still a healthy deal and it still works, today. One of the indicators that is becoming increasingly important is the debt service coverage ratio, right? It's like, how healthy is this deal? So, okay, cool. So dig in, find a deal that makes a lot of sense today, buy the deal. And then as the market improves, then whatever deal there is that's healthy for that point, buy that deal too. You'll have this portfolio, right, of varying returns and things like that. But trying to wait and time the market, waiting until it has some full recovery, until it fits what we used to see, what we saw 2 years ago, 3 years ago, that's what causes a lot of people to stay on the sidelines and really just wait forever.
Because you miss it, right? You're never going to time it perfectly. Like right now, in my mind, it's like, yes, there are some deals that are struggling, and now could be an interesting time to, if you've got some dry powder, which it sounds like a lot of these big institutional buyers are kind of salivating for, this Armageddon that's potentially going to happen in multifamily with, $1 trillion in debt that needs to be financed or figured out in the next, 24 months or 10, 12 months, something like that. So I think this is an opportunity for people that, if you have cash and you're willing to, take a little bit of a ride, it could be a really amazing time to invest in multifamily, because, we're still in a housing crisis where, there's people can't afford housing, and, rents, there's not enough housing available, et cetera, et cetera. And so, this could be an interesting buying opportunity. Again, to your point, not overpaying, making sure you have conservative underwriting, that you're not, bumping rents $300 like people were bumping them, a year ago, because they're just not seeing that increases depending on the market, right? I don't know every market, but some of the markets I look at. So, yeah, it could be interesting. And so going back to my questions a little bit, like where are you targeting? Are you still looking in Houston? Are you looking in Northwest Arkansas? Or like where are you kind of narrowing your focus on actually looking at deals?
So Houston, DFW, and actually starting to look at Richmond, Virginia as well. But yeah, Houston, DFW are still kind of the two my two core markets. Houston's kind of taken a bit of a market shock, I'll call it, just because the property taxes have just kind of gone through the roof, and
insurance has gone up crazy.
Yes,
yeah,
which makes obviously constrain a lot of deals, and so But yeah, those are my three core markets right now. I mean, Richmond, Virginia is one of those markets where there's a lot of revitalization going on. And I just, I think it's a really good, there's even some positive movement so I'm up here in DC, and there's a lot of movement from Northern Virginia down to Richmond. So there's some interesting things going on in that market as well.
Well, yeah, I mean, the world that we live in this hybrid work environment, in some companies still being fully remote and all that, it gives you the flexibility to maybe live a little bit farther away from, if you work in DC, it's like, well, maybe I don't know how far away Richmond is, so this may be a moot point, but at least you can move farther out. So it's like, hey, if it's, instead of being a 30-minute commute, it's an hour commute, but you only have to do it once a week. It's like, well, that's probably feasible and doable and all that stuff. So
yeah.
So yeah, I think that's interesting. I haven't looked in Richmond in my, but everybody knows the markets that they know, and I think it's I like DFW. Houston's a little bit sketchy for me, just from a hurricane flooding perspective. DFW's kind of had issues with hail and all that stuff, but it is what it is. So. So I guess, as we kind of round this out, we've been talking for a while here, so I appreciate all the time that you've donated to this podcast, and the immense amount of wealth and of information you've handed out to all of the listeners. But I guess, what are you thinking, let's call it the next 12 months is going to look like? Maybe a little crystal ball action here, and just kind of think through. Like I said, I think it's a potentially good buying opportunity. Do you agree? And what do you think will kind of transpire over the next 12 months or so?
I definitely agree. Look, so the gap is closing, right? We've been hearing a lot about that recently. Of course, before we were concerned about the bid-ask spread, but that gap is starting to close, which means that sellers are starting to kind of, understand a little bit better that, hey, we're going to have to come down on these numbers. We have a lot of deals that are in trouble, but the fundamentals are still there. Right. So one of the reasons I love the Sun Belt is because you still have this strong positive net migration. You have strong jobs that back it, and in some of these markets you have supply constraints. So the fundamentals are still very much there, and in a historical sense, the interest rates are not high enough to kill a deal. Depending on which type of debt you go for. Yeah. So it just I think that right now is a great time. I think that in some of the deals that are in trouble, as they hit the market, they're hitting the market at a discount. They have to. I do think that this is a good time. I think that we are, obviously I'm not going to say that we're in recovery, but I'm saying that we might be heading into recovery from a fundamental standpoint. And people who try to time the market, they're just going to be late. I mean, that's usually what happens.
That's right. Yeah. Timing the market is tough for sure. And whether you're looking at stocks or real estate, it doesn't matter. Timing is what is it? You can't time the market. It's all about time in the market.
That's right. That's right.
Awesome. Well, Brandon, let's shift to the 3-pack of questions I ask every guest to kind of round out the show here. So question 1, what is the one piece of advice that got you started or helped you along your real estate investing journey?
I think it's definitely that you have to attract capital. Because for me, that's obviously become useful in my role now. But I try to, print out the list of my contacts, run down that list, and make a bunch of calls. And that's backwards. What you do is you make sure that your network, first of all, knows that you're investing in this space. so that you can start to really garner some interest early on and have them warm so that they're ready for an opportunity when you present one. So I believe that positioning yourself to attract capital is the superior strategy. So that's one thing that for me has been really made an impact on my business and on how I operate.
No, I think it makes a lot of sense. Yeah, trying to sell somebody a deal is not the right approach in my mind. So I like it. All right, question 2. What is your favorite real estate or business book that you're into right now?
So business book, I like Who Not How a lot because it's partially because I struggle so much with that, man. I try to do everything myself. And so in reading that book, I'm like, you know what? That's a strategy. It's a philosophy that I adopt now, because there are a lot of people who just by this exchange that you're helping them, they're helping you, and you're able to scale your business that much faster. So that for a business book, that's important. And for a real estate book, I really like Gary Keller's The Millionaire Real Estate Investor, mainly because when I read it, I read Rich Dad Poor Dad before that, but when I read Millionaire Real Estate Investor, that's one of the things that gave me that kick to say I need to go and meet with these lenders and credit unions. So that one is kind of near and dear to my heart there.
Yeah, I mean that was your light bulb book. Rich Dad Poor Dad was mine. However, I had a very similar reaction to Who Not How, and my wife read it, and we're in the process of hiring a VA.
All right,
because it is that, like, you think about all the little things that you like, that you want to do, but you just don't do. And they build up, and you're like, what if you had somebody that you could just push that out to and not about how do I get this done, but who can help me get this done? So, and you're a who to people when they are interested in learning about raising capital. You're that who that helps them along that journey. So it's a super fascinating book. I can't recommend it enough. So I'm glad you brought that up. All right. Last question. If you hit your financial freedom number, meaning you could live an amazing life just off of the passive income from your real estate investments, what would you do?
Oh, that is a good one. So from a couple things. One is my family and I, we love to travel. And so we would just do more of that. But I will say that one thing that's important to me is making an impact. And I remember watching, I guess it was Undercover. I forgot whether it was Undercover Boss or Undercover Millionaire, one of those. And I remember seeing an episode where the guy was working at like a recreation center for troubled youth. And so the guy that was undercover at the end, he, cut a few large checks for that guy and his family to like expand the rec center. He helped some of his I think he had a couple kids that the guy paid for their college. And so just seeing the impact that he made at a large scale. And that's what I want to do. So I want to eventually be like a 7-figure giver. So I want to be someone that has enough coming in to where I can give on such a large scale to where that one contribution or 2 contributions makes a huge, huge difference and impact on someone's lives.
No, I think that's awesome. That sounds like a very worthy thing to do with some of the money that you're getting from real estate in this ideal scenario. So no, that's awesome. I think that's great. So, all right, Brandon, if people want to get in touch with you, if they're in the DC area and want to meet up with you, like what's the best way to connect? How do they find you?
Sure. So I'm on LinkedIn. I'm on Facebook. My name is Brandon Jenkins, a pretty common name, but good luck there. You can email me, Brandon.Jenkins, BRANDON.JENKINS @BirchProsper. That's the name of my company. Birch Prosper, BIRCHPROSPER.com. I have a podcast as well that's called the Capital Stack Podcast. I think that's kind of the main ways to reach out to me. So.
Got it. No, we'll put all that stuff in the show notes. So appreciate that. Appreciate the time, man. This has been super awesome to get to meet with you and learn about your world and share it with the audience. So thanks for being on the podcast.
Thank you so much for your time. I mean, for having me as a guest on the podcast, Justin. This has been absolutely awesome, and your platform is incredible. And I just, like I said, I can't thank you enough for having me as a guest. Thanks.
You're welcome. Talk to you soon.
I hope you got value out of this episode of the Work Hard, Invest Harder podcast, your one-stop shop for education on how you can continue to work hard in your career and have different options to invest even harder. If you took anything away from this episode, please leave a written review. I read every review as it helps me serve you better. If you're listening to this podcast, it means that you want to grow your passive real estate portfolio. The easiest way to do that is to join our investor club by heading to greatventurecapital.com/invest. The link is in the show notes. See you on the next episode.